Hello everyone, welcome to today's US Open live webinar. It is Tuesday, January the 10th, and we're 10 minutes before US markets open. This is your host, Nikos Tsabouras. This is the first session of the new year in what looks like it's going to be another exciting year in terms of market activity and developments. Today, eyes are on Chair Powell, who participates in a panel discussions in Stockholm, which has already started. Of course, we don't know if he's going to make any reference to monetary policy. We're going to have to see. But before we go into our discussion today, please read carefully the disclaimers and the warnings. Once again, please read carefully through the disclaimers and the risk warnings so that we can then get started and talk about the themes that are driving markets today. Okay, let's go ahead. As we're looking at the chart of Euro USD, before we get into the technical analysis part, let's see where we stand in terms of news and market developments. This week started with hopes for a less aggressive stance from the US Fed. After Friday's US data points, we had the NFPs on Friday, which showed another deceleration in the jobs creation pace. And we also had wage inflation easing with the smallest decline of 2022, whereas the services sector contracted for the first time in over 2 years, while factory orders dropped by the most in a similar time period. So adding to this risk on mood was also the relaxation of COVID-19 measures in China, and especially around international travelers, as China seems to be moving away from, let's say, infection prevention to severe disease prevention. This all helped market mood, but markets appear more cautious today, with the US dollar finding some support and Wall Street futures being pressured. It's light. The start of the week was light in terms of data points and news, but things starting from today start to heat up. Once again, Chair Powell is in focus today as he participates in a panel discussion. It's not related to policy, it has to do with central bank independence, so we do not know if he's going to refer to policy matters, but there will be audience questions, so there's always a chance that we will get something out of it. So let's go ahead and go over to Euro USD. We already talked about Friday's data points, which created hopes for a Fed pivot, and this worked against the greenback, and Euro USD rallied on Friday. So you can see this is the post NFP rally on Friday, the one that we're highlighting, which is also held by the contraction of the services PMIs. As the thinking is that if the economy is not doing well, the Fed will be forced to be less aggressive. Markets don't seem to believe that the Fed will hike by as much as its projections suggest. And for instance, if we look at the CME Fed Watch tool from the CME, a smaller 25 basis points hike is priced in for the next meeting. The highest probability is assigned to rates peaking at 5%, and it also shows, it points towards rate cuts towards the end of the year. Now, the Fed is more hawkish. It expects its last projections from December point to a median terminal rate of 5.1%, higher than what markets expect. And last week's accounts of that last policy meeting showed that no participants, and I quote, no participants anticipated that it would be appropriate to begin reducing the federal funds rate targeting 2023. So there is a disconnect between what the Fed is saying and what markets expect. That's why any comments for Chair Powell and other officials ahead of the next meeting, which is on the next decision, which is on February 1st, are very important, since there is some preparing that needs to be done. Now, at the technical front, the week started strong with after the impressive finish of last week. And I also want to point to the daily chart on Euro USD, because we have a potentially important technical formation there. Let's pivot to the daily chart. You can see that there is a golden cross that has formed on the daily chart. A golden cross is generally when a faster moving average crosses above a slower moving averages. I usually focus on the daily chart and the exponential moving averages of 50 and 200, and that's what we have here. And this can potentially lead to further gains. Of course, it's still early in order to be able to assess the validity, but this is usually points to further strength. Now back to the 4-hour chart. Yesterday, the pair hit 7-month highs and now tries to take out the May highs. It's this level here. You can see at around 1.07087, but we're not sure if it is ready yet to attack the 50% Fibonacci over here of the 2021 high, 2022 low drop at around 1.0942. Now, as we said, however, the Fed does maintain its hawkish stance and has not shown any inclination to change tack. So there is a chance of a pullback, which could be at around the 38% Fibonacci of the aforementioned Fibonacci at 1.609 roughly. But a strong catalyst will be required for daily closes below the broader 1.05 area, which is the EMA 200, the black line here. We would need to see daily closes below this level to negate the upside bias, and this seems to be like a tall order. Some strong catalyst will be required for such a development. Of course, there are potential catalysts ahead, but we will talk about it later in the session, along with a brief commentary in the upcoming earnings season. Now, let's leave Euro USD. I also want to take a look at gold, and we're looking at a 4-hour chart here. So gold had a strong start to the year, rising to the highest level since May yesterday. This is it. It is sort of consolidating its gains today. Again, the catalyst here is partly expectations for a less aggressive Fed, for a Fed pivot. It has now the chance to, gold now has the chance to push for the resistance at 1,909, but probably fresh impetus will be required for taking out this level and bringing 1,959 in the spotlight. It does seem to lose steam. It did seem, but now we see that it finds renewed support. We couldn't we cannot rule out a break back below the 50% Fibonacci of the 2022 high-low drop around this level, 1,842. But again, there is significant cluster of support lower that can actually contain any more weakness. And of course, this is the area that we highlight here. That includes the EMA 200, includes the 38.2 Fibonacci level. So that's a tough barrier for weakness below that level. And we're 1 minute past the open of the US market, so let's go ahead and round off things with the outlook for NAS 100, the tech-heavy index. Once again, we're looking at the 4-hour chart. So similar themes driving markets. We can see that we had a strong start to the week, as it had the sales in NAS 100 has the wind in its sails from Friday's data points, but it rejected key technical levels. This region here, which includes the 38.2% Fibonacci of the December high-low drop, the daily Ichimoku cloud, and the EMA 200. This creates a perilous state for the tech-heavy index, as there is risk for lower lows around this area. Although sustained sub 10,437 moves will require significant sentiment reversal. We can see that as we speak, the index finds support and defends the 11,000 level. And as such, we can see an effort to push higher, but the upside does look tough, and it's probably going to need some catalyst to break through all the above barriers, the upper border of the daily Ichimoku cloud, for instance, and in any case, the 12,000 mark looks distant in this environment that we are now. Now, let's go ahead and see what we have coming up ahead of us. Now, a catalyst for Wall Street could potentially be the start of the earnings season. Big banks report on Friday, such as JP Morgan, in a backdrop of Goldman Sachs reportedly being about to slash more than 3,000 jobs. So that sets an interesting backdrop for the big bank earnings. And of course, we also have Delta Airlines due on Friday. Delta Airlines has been riding, let's say, the recovery wave of the broader airline and tourism and hospitality industry. It reported record adjusted revenues in Q3, and now we expect the Q4 result. And it had provided a bit outlook for the soon-to-be reported quarter. Of course, we'll have the chance to talk about more the earnings, which again start, as we said, on Friday, over our next sessions, and the one on Thursday, the next one. And other things ahead is, of course, the US December CPI inflation update. This is what stands out on Thursday. We'll talk about the results, the outcome of this release on our next session on Thursday. But let's remind here that headline CPI had been easing since the June 9.1% peak year over year. The last reading was at 7.1%, which is the lowest in a year. Core had peaked in March and at 6.5, and we have seen a deceleration there as well. And the last print was at 6% year over year. So definitely inflation has been moderating inflation pressures, but the Fed is not yet satisfied. So we'll see how these things play out. Once again, we have Chair Powell participating in a panel discussion as we speak, and we will be looking to see if we will get something around policy. That's it from today's session. Thank you for joining. We'll talk again in 2 days on Thursday at the same time, 14:20 GMT, 10 minutes before the US Open. Thank you.